Live from Bloomberg's brand new Mumbai studio, this is Inside with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks rise as President Trump delays tariffs on Canada and Mexico by a month after they agree to tougher measures against migration and drug trafficking at their borders. Now investors are focusing on how a potential call between Trump and Xi Jinping pans out and whether China too will get a reprieve as 10% tariffs loom. GQG Partners portfolio manager Brian Kersmanc joins us with his firm's strategy to deal with the Trump-induced volatility, and we'll talk about their exposure to India as that market falls out of favor with global money managers. And later we're joined exclusively by Indian tycoon Sanjiv Bajaj with his outlook for the country's economy and its financial sector as the government looks to boost consumption. Well, almost as quickly as he announced them, President Trump has now backed off on planned tariffs against Canada and Mexico. The moves avoid a continental trade war in North America, at least for now. Both Canada and Mexico managed to avoid the tariffs until at least March by agreeing to new measures on border security and immigration. Prime Minister Justin Trudeau says Canada will name a fentanyl czar and partner with the U.S. on a new strike force against organized crime, drug trafficking, and money laundering. And Mexican President Claudia Sheinbaum will deploy 10,000 officers to the border to stem the flow of fentanyl and migration into the U.S. Meanwhile, Trump's 10% tariff on Chinese imports is still scheduled to take effect in just a few hours. The White House has told Fox News that there's a plan for Trump to speak with Chinese President Xi Jinping. For more, let's bring in our Chief North Asia correspondent, Stephen Angle, in Hong Kong. Well, Steve, that 10% tariffs was already a boost for China, good news for China. Now there are talks, and that could be further good news.
Yes, so I think a lot of people in Asia Pacific woke up this morning and saw those headlines about a reprieve, at least 30-day reprieve for Mexico and for Canada on their border issues and the tariffs of upwards of 25%, and maybe extrapolated a little bit saying, well, a similar deal might be in the works with China, and it very well could be. But we're hearing that Donald Trump and Xi Jinping will have a phone call, as Donald Trump said a few hours ago, within 24 hours. The problem is the clock is ticking, as you just showed the countdown, less than 2 hours until that deadline is reached, where that 10% tariff is imposed on Chinese goods across the board into the United States. So can they avert it? Well, the markets have been a bit optimistic that they can have a similar result as Canada and Mexico, but the clock is running out of time, essentially. The speculation now perhaps is there will be the tariff enacted, and then there will be negotiation. And the bigger question is, what can Xi Jinping pledge that would be commensurate with what Justin Trudeau and also the Mexican president were able to give to Donald Trump, because the fentanyl issue is a sensitive one. I think there's a previous guest in the last hour even said if Xi Jinping wanted to shut down the illegal trade or the illegal manufacturing of those precursors for fentanyl, he could probably do it. But there would have to be an acknowledgement that there is the problem going on in China, and that there is something that the top leadership in China can do about it. So far, in the last couple of days, we've had the Ministry of Foreign Affairs in Beijing essentially put the blame on the Americans' demand for fentanyl. This is what the Ministry of Foreign Affairs spokesperson said in a statement Sunday. The U.S. needs to view and solve its own fentanyl issue in an objective and rational way instead of threatening other countries with arbitrary tariff hikes. State media has been also mimicking a similar message.
Steve, it is a negotiation. You got to wonder how far China is willing to go, given the fact that its economy is still struggling.
Yeah, so, there's going to be multiple responses from the Beijing leadership as they come out of the Lunar New Year holiday. Today is essentially the last day. Markets reopen tomorrow, and there will be some sort of response. We saw that in trade war version 1 in 2018, 2019. There were retaliatory reciprocal tariffs. There were other export curbs on key minerals, and there were other moves essentially to try and counter the protectionist, or I should say the trade action from the Trump administration version 1.0. There will be similar ones this time, but the problem is, as you rightfully said, Haslinda, the Chinese economy this time around is on more shaky footing. So you have to be careful how far you punish, that you don't punish your own economy. But we do expect some sort of retaliatory steps, especially if the tariffs from Donald Trump go beyond just the fentanyl issue and target upwards of the 60% that was threatened by Donald Trump because of the imbalance in trade.
Stephen Angle, our Chief North Asia correspondent in Hong Kong. Thank you so much for that. Now, Asian stocks, meantime, enjoying a reprieve after Trump delayed those levies on Canada and Mexico. Avril Hong takes a closer look as a U.S. deadline on China tariffs looms. Well, we're looking at gains pretty much across the board. Avril.
Yeah, that reprieve on Asia markets led by the Hang Seng. The idea that after Canada, Mexico, Colombia got delays, reprieves, that China could experience the same. That optimism is what's fueling the Hang Seng today, which is leading the charge, boosted by the tech names, jumping by the most, the Hang Seng, since October to the highest level since November. And the idea that not only China might get a delay when it comes to tariffs, but also since tariffs have already been announced, that Chinese authorities can bring out the big guns when it comes to stimulus. There's also some of the DeepSeek beneficiaries potentially that are rallying, that's fueling the charge. Dollar China, we're seeing it pulling even further away from the 737 levels that we saw a day ago. And all this kind of mirroring the moves, the reversal in the loonie, Mexican peso, dollar, oil. Flip the board, because as we see these risk assets rally, I thought I'd just inject a dose of skepticism here, because we are seeing that flattening in the 2s and 10s on U.S. Treasuries. Indeed, that's been what we're seeing for the past month. Yesterday, a bit of that exacerbation as well. Selling on the short end given the inflationary concerns, and buying on the long end given growth concerns. And to some, as long as these trade war concerns linger, that we might not just see further flattening in the curve, maybe inversion as well. That might be a likely outcome, Haas.
Avril, thank you so much for that. Let's get more market perspective from Brian Kersmanc, portfolio manager at GQG Partners, which manages over $150 billion in assets. Brian, good to have you with us. So Trump delays the tariffs, but truth of the matter is that tariffs are coming. It is higher for longer. We have a strong dollar. Now that Trump is in office, Brian, does that change the way you trade?
Yeah, well, first of all, thank you very much for having me back. I really enjoy being here. And then, to kind of address the issue, there's a lot of noise going on in the markets at this point in time right now. There's a lot of things that are going on back and forth, and we do see sort of these trade tariffs being announced and sort of recalled back or pulled back, and the negotiations coming through. I think what we need to look at is what are the longer term implications of this, and what's the longer term path in the grand scheme of things. And if you look at it from a Chinese perspective, at least, the U.S. on both sides of the aisle, both the conservative side, the Republicans and the Democrats, are all pushing for more restrictions, possibly fairer trade treatment and things along those lines with China. So I think that is a little bit more of a one-way street, even though you might get some temporary reprieve and sort of back and forth with things along the lines in sort of the medium term there.
You talk about longer-term implications. What are the longer-term implications for emerging markets in particular? Because that's your area of expertise. We've seen an exodus of $54 billion in terms of money getting pulled out of emerging markets. I mean, how do you see this asset class performing?
What's interesting is there's been a couple of times over the last couple of decades almost, where emerging markets has been called almost a dead asset class. Since you said, okay, well, it's become sort of uninvestable, you might as well just invest in sort of global assets and have sort of EM be a little bit more of a carve-out allocation. And what seems to happen in each one of those periods is you have a new leadership that maybe evolves out of that EM asset class. So we've been in a period over the last several years where China has been taking the lead with a large portion of that growth. But their economic growth has slowed down. They've been, sputtering a little bit from an economic growth standpoint, and obviously having sort of the U.S. implications back and forth from a trade standpoint hasn't necessarily been as interesting. For us, though, there's several other markets within the EM landscape that look really interesting. You had cited before sort of the preview that India, we still have a strong belief that India continues to chug along very well, and some really interesting things there. So again, some of the things that we're finding very interesting in some of these other markets, even outside of China, within that EM context, there are other things there within EM other than just China.
Isn't it true, though, given valuations are so high, 25 times PE, 24 thereabouts? I mean, it's still looking pretty expensive, and earnings have yet to catch up when it comes to the Indian market. Why are they still attractive to you? Are there expectations, perhaps, Indian earnings will improve?
So in aggregate, I would say that the Indian market is expensive. And you look at some of the consumer-related items, those consumer-related companies, fast-moving consumer goods, durables, things along those lines. By the way, some of those got some benefit from some of the the budget sort of the agreements or the announcements that have been made over the past weekend. But what other areas that we're seeing are very strong growth are things like infrastructure, utilities, and things along those lines. And yes, there is a higher price tag that you're paying for some of that growth, but the growth is actually coming through in a very strong way. And I think what goes under appreciation is there is a durability or visibility in that growth on a longer term basis. And I think people underappreciate that there is that tail that has a lot of value as well. So structurally, that's going to come with a higher price tag if you have that visibility and durability of growth on a longer term basis.
I want to touch on Adani. Amid the bribery allegations, GQG capped its shares in Adani. I'm just wondering where you are with that. Have you done anything since December?
So in terms of the positioning sizing, we've kind of stayed pat where we were. Obviously, you have something like a DOJ investigation and sort of indictment that is sort of filed against any one of the companies that you're looking at or invested in. That's something you take with a very serious matter over the course of time, and you make sure that you go back and underwrite and understand what the risks are. After doing that due diligence on our side from multiple different angles, we came to the conclusion that this has a very minimal and modest impact on the businesses themselves. And you actually seen that come through in terms of the earnings. Most of the Adani groups, actually all of the Adani group names, have actually reported earnings and have had fantastic results. So that's one of the things that we've seen and continue to see over the course of time. And fortunately for us, the timing of sort of the initial investment, we're still largely in the positive territory by a large margin over the course of time since we first bought these back in 2023.
So would a dip be a buying opportunity for you when it comes to Adani shares?
So in terms of a dip from here, again, we have a fairly large position size in the grand scheme of things for where we feel comfortable where the risk reward is on these particular names. So we're pretty comfortable with the positioning and the sizing that we're at right now. We came in, a decent size. So I think we're comfortable where we are, but I think it's also a context or in context of the broader opportunity set that we see in India. So you are seeing a lot of those infrastructure sort of, growth that's coming through in a lot of different areas. It's not just the Adani group, although we like that as well. If you look at like a GMR, for example, second largest airport infrastructure company in the entire world on the listed side, 120 million passengers, growing at sort of a high single digit plus pace in terms of growth, in terms of, the passenger growth over the course of time at high levels of profitability. The telecom sector, you have finally a consolidated telecom sector with three players, two of which are starting to lead pricing in a bigger way. Mid-teens, growth in terms of pricing on mobile plans, high teens growth in terms of revenue. I mean, these are rate plans. Think of a 5G rate plan costing you $7 a month. This is in USD terms, $7 a month for an unlimited 5G plan. So they have plenty of runway to continue to grow that average revenue per user over the course of time. So we do like Adani. That is just a small portion of the larger allocation that we have within sort of the India sort of investment theme.
Brian, we know that in terms of stocks that you like, they include NVIDIA. You dialed back your holdings on risk management concerns, but you still like the stock. at least when we last spoke. How do you look at NVIDIA right now?
Yeah, it's interesting in the tech landscape. Obviously, you had DeepSeek and sort of the big announcement that happened in terms of their ability to do those models at a substantially lower level of cost or initial investment to sort of train in the equipment and things along those lines using them. The hard part about tech in the grand scheme of things is tech is a very growthy business, but also a very highly disruptible business. You had mentioned we did cut back in tech in general since a very, very hefty allocation earlier last year to being modestly underweight at this point in time in tech, in the grand scheme of things. Now, there's some pockets that we still like, but I think it all comes with a grain of salt, and there is that disruptability. And kind of going back to that EM landscape, and I think you think about it from a global perspective, what will be one of the better diversifiers away from sort of what we're seeing in the grand sort of tech scheme of things with all of this innovation and disruption coming through? It will be some of these maybe a little bit less loved markets within the emerging market landscape, or less loved companies that are still exhibiting really strong earnings growth. So think of like a Brazil that still has high single digit, maybe even low double digit loan growth within their banking system. NPLs, the non-performing loans are coming in better. Credit quality is coming in better. So you are seeing some pockets in some of these other markets where things are very interesting. That will be a really good diversifier to any sort of missteps that may happen within a tech landscape on a long-term basis. I think it's one of the better diversifiers out there, quite frankly, in the grand scheme of all the things you can own globally.
Brian, I want to get back to NVIDIA and take you back to DeepSeek Monday, where NVIDIA slumped 17%, wiped out $600 billion in its market value, was the biggest single-day drop ever in market history. I mean, how do you read something like that? Is that an indication perhaps we've reached tech peak?
So I think you maybe even reached tech peak a little bit before that in terms of NVIDIA. Saw the shares kind of peaking out. Sort of the craze of some of the watch parties that you saw around NVIDIA and things along those lines with people looking at the earnings results. Now, NVIDIA is still a fantastic company. We still like it. We still think there's a tremendous opportunity for growth. But I think what DeepSeek did introduce, whether you believe the number of sort of GPUs that they used, or what number you choose to sort of use in your calculation for the number of GPUs they used, or how they sort of got to their model and did their model in the grand scheme of things, there was always going to be some sort of tech innovation that was going to happen to drive some sort of efficiency. Now, what we've seen is that some of these folks, like a DeepSeek, have been able to use some of these GPUs in a more effective way, using some of the different components of memory in a much more efficient way so that you didn't have to use as many of these chips over the course of time. That is just a natural stage of evolution. There is a necessity to do things more efficiently and drive down that cost. That was going to happen. And that was kind of what NVIDIA was running against, despite the fact that they still do have the best mousetrap out there from a chip perspective and from a system perspective. That's something you need to take into consideration all the time. Again, tech is one of the most highly disruptible spaces, even though there is an attractiveness in terms of the growth. So that's something you need to have in the back of your mind every time you're investing in this space.
One person at least called DeepSeek a smuggling moment for China. I'm just wondering, if you take that into consideration, would it be a good time to perhaps explore Chinese AI-related stocks? Have you been exploring? What are you looking at?
Yeah, so in fact, we've been very large holders of Chinese, tech companies in the past. We've been pretty underweight, if in fact almost non-existent over the last couple of years, because quite frankly, they haven't been growing as much. We haven't seen sort of the returns in the earnings coming through. Now, it is interesting that they've been able to leverage some of this technology to be able to grow and maybe even catch up with the capabilities of what we're seeing in the West. But a lot of these models are open source. So some of the innovations that DeepSeek has now sort of incorporated and brought into their sort of models and the way they did things, that's also been open source and being fed back over and sort of used on sort of the Western side. So I think you'll see this sort of innovation going back and forth. And one of the things that we're looking at is, okay, well, who is actually driving the benefit? Who is extracting the benefit out of all this AI investment? Who's getting a real return on investment? And one of the few areas that we're seeing that's really generating that return are sort of these ad tech business models, media type businesses like a Meta, for example, that uses that AI to get stickier eyeballs onto its platform. They're putting better content in front of you. And then they're using that AI, that generative AI, to be able to put better advertising in front of you while you have a stick your eyeball onto that platform in the grand scheme of things. That has a lot of value to advertisers over time, and you're seeing real returns on the back end of that. So if you look at sort of our positioning, we've rallied around and sort of stayed around some of these businesses where you have actually seen a real return on investment from that side of things. So I would say that advertising space has been a beneficiary. That's more where we're preferring to sort of stick around and sort of venture off into where folks are kind of going back and forth and fighting head to head in terms of tech superiority.
Brian, before we let you go, if you take a macro perspective and you take a look at the equity markets right now, some people are already suggesting that even though there's not a bubble yet, some signs are showing that it is forming. What's your take on that?
Yeah, so if you look at some areas, there is some expensive areas within the market, definitely. You do see that. I think one of the things that we've looked at, kind of taking a step back, is that if you look at the performance of a lot of financials, and you look at sort of the earnings that have come through, most recent quarter, but then also in the past couple of quarters, it's been astonishing how strong the consumers have been. This is insurance businesses, P&C types of businesses, life insurance businesses, but even the banks and sort of the investment banks and the animal spirits coming back to some extent. I think that underpins that we actually have a fairly solid underfooting. And so it's not a situation where we're fearful that there's sort of credit cracks or things along those lines. And maybe you could see the sort of the economy continuing to chug along. Now, there are going to be a little bit pockets in some of these places. Again, some of these tech areas, maybe there is a little bit too much investment and there's going to be some restraint or some pullback there. That goes back to the old tech adage. You always overestimate what is the potential implication in the short run and underestimate the longer term implications of sort of the technology or disruption over the course of time. We might still be in that sort of overestimation period with some of these businesses, especially on the AI side of things.
All right, so cautious the word. Brian, thank you. Always a pleasure to have you on the show. Brian Kersmanc of GQG Partners. Some breaking news out of Indonesia to tell you about. Indonesia is set to shift $61 billion of state assets into a new fund. And speaking of this new fund, it has been created by President Prabowo Subianto, and it will oversee the state assets and report directly to the president. The fund will have broad control over capital injections as well as restructuring, and will be central to Prabowo's economic agenda to boost growth and investment. Remember, just to give some context to this, President Prabowo wants 8% growth. It needs funds to do that, and this could be one way of doing it. Indonesia is setting to shift $61 billion of state assets into this new fund. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, what a difference a day makes. A reversal in fortunes for equity markets. That includes the benchmarks in Hong Kong. China, of course, on break. It is on holiday till tomorrow. We'll see the reaction when it comes back to the market, though. When it comes to the Hong Kong benchmarks, they are in positive territory. The Hang Seng up by almost 2.5%. The other benchmarks in the city also in positive territory. Asia's Tech, take a look at that run. Almost up by about 5% as we speak. Of course, that reversal in terms of Trump tariffs being delayed by about a month, providing that relief. Up next, exclusive insights on India's insurance and financial sector with Bajaj Finserv. We'll have details right after this. This is Bloomberg. You're watching Insight, coming to you live from Bloomberg's brand new studio here in Mumbai. Of course, we're doing a check on Indian markets. Take a look at how those yields are doing. We're also tracking the Indian rupee. Remember, it sank to a new low just yesterday on the back of that mighty dollar story. Some reprieve coming back to the currencies in Asia. But today we're seeing the Indian rupee at 87.19. As we speak, it is higher by about 0.2%. Of course, when it comes to India, Prime Minister Narendra Modi has been invited to meet with President Donald Trump in Washington next week. It is all about those negotiations. Can India escape those tariffs that Trump's imposing to almost all his neighbors, foes, as well as friends? Well, joining us exclusively to talk about India here in the Mumbai studio is Sanjiv Bajaj, Chairman and Managing Director at Bajaj Finserv. Good to have you with us.
Good to be here.
Great starting point is the budget. What are some of the key takeaways? How much of a boost do you think that will provide consumption and the Indian economy?
So firstly, congratulations for the Mumbai studio launch. Great to be here. The budget has been both good and clever. It's recognized the current slowdown, keeping in mind global uncertainties and headwinds. And that's why the income tax benefit to the middle class, the continued infrastructure investment, the additional benefits to states to up their investment focus as well. All this should help to take the economy back to a higher level of growth. At the same time, there is this recognition to build India for the next 5 years, 10 years, and longer. And that's why if you look at the next set of investments that the government focuses on, whether a set of new sectors, toys, leather, these will get support because these are also large employment-driving sectors. That's a big positive as well. The focus on skilling, the focus on AI, agriculture. As we know, a large part of our inflation is food price inflation. And by focusing on some of the staples and increasing production and stabilizing that over the next coming years should help us as well. So that's why I would, and all this while keeping a tight eye on the fiscal deficit. That's why I call it both good and clever.
I want to pick out two things that you highlighted, the creation of jobs as well as upskilling. Some say that not enough is being done to create those new jobs. I mean, we're seeing unemployment at 40%, 30% of grads still don't have jobs, and upskilling not being done enough to put those people in the right places, in the right economies for the future. Your thoughts on that?
You know, in a country with 1.4 billion people, it's never going to be enough, and the left side and the right side is never going to match in the short term. Because if you're a city-state, if you're a state with 100 million people, much easier to do. But if you see the changes that are being driven both by the government and the private sector, one, if there is steady consumption and increase in demand, whether domestic or export-driven, you're going to see private sector investment come in. Second, in the last decade and more, the significant improvement in infrastructure, in supply chain efficiencies, is helping us becoming cost efficient from a global perspective. So that's what the state is allowing us to do or enabling us to do. The third then is matching capabilities on jobs, requirements and skilling. Look at the same students. They graduate from our STEM colleges and they become CEOs of global companies. Look at all the American technology companies. Most of them have Indian CEOs. They've all gone through the same education. But yes, there is fine-tuning required. The world is changing. We're becoming more digital. AI is coming in. So you need to make sure that your skilling keeps pace. And it's not about skilling 1,000, 100,000, a million people. We are talking about skilling and getting ready 20, 25 million Indians that come to the job force every year. So that's a big task, but yes, we have to keep working on it.
Not everyone is buying into the India story right now. If you take a look at how foreign investors have been pulling money out, take a look at where the rupee is trading right now, hovering close to record lows, if not still at record lows. I mean, are we reading too much into it?
I believe we need to differentiate between value and valuation. Valuation, I'm not an expert, but from what I see, markets like India are reasonably at their peak, and that's why there could be an opportunity to take some money off, and you can see domestic funds coming in every time. And this is a big change compared to even 5 years ago, where our stock markets were almost entirely driven by foreign money. Today, the domestic average Indian is putting in enough money into financial savings to be able to balance that. But at the end of the day, you still need the right return for it. So valuation, one can debate. as far as value is concerned, India is one of those few countries that offers you intelligence at very competitive costs. But yes, it's not necessarily the easiest country to do business in. So we have to keep improving. There's a lot of improvement that's happened in the past decade and more. But we have to keep moving because it's a moving target. And that's why you've also seen in the budget a next set of announcements on ease of doing business. We have to see those getting rolled out. It has to be executed. Just talk doesn't take us ahead. But we have seen this government do that time and time again, and we have to work with them to make a difference.
Sanjiv, what does it mean for your business in terms of retail credit, for instance? What kind of increases are you looking at? What positive signs are you seeing?
So, the helping on the income tax side is going to result in greater savings. Part of that, I think, will go into consumption. Part of that will go into financial savings. We are at about $2,700 per capita, but there is an India of 80 million people that earn the same amount of money as Europe. There's an India of 400 million people that earn the same amount of money as Indonesia. These Indians are saving and they are spending. As we keep spurring them and give them confidence that India is growing, and this budget ends up supporting that, we should see a lot more consumption. And for us in financial services, when the real economy grows, the financial services sector grows 2 to 3 times that. So I see great years. I believe the next decade is India's golden decade, but we have to just work hard, keep our heads down and get it right.
In terms of your own growth, retail credit for the next 2 to 3 years, realistically, what kind of growth can we anticipate?
Well, on the retail credit, we see the opportunity for us at Bajaj Finance to grow at 20-23% year on year with very good quality growth. And we see ourselves growing across sectors, whether it's retail, whether it's mortgages, whether it's small business. We see that opportunity that the country provides.
We know that the RBI, for instance, I guess, has greater scrutiny on NBFCs. They're concerned about some of the services or how big they've grown. We know that Finserv, for instance, has grown phenomenally in a very short period of time. I'm just wondering whether there is any value in pursuing a full bank license for you.
So one, RBI has been a very mature regulator, and if you see us right through COVID, we're one of those few large countries that came through economically reasonably unscathed. So a large part of the credit goes to them, goes to the government, and the role of the private sector as well. We welcome the additional scrutiny because it also helps us become more robust. All we tell them is, let's provide a roadmap to where you want to take us so that we are not caught by surprise, because we are large organizations. It takes time to change that. The RBI a few years ago categorized NBFCs like ourselves into multiple layers. And we are in the upper layer. There are 15 of us, large ones. Many of us are bigger than many banks, as we know. But this categorization has created a formal recognition for the large NBFCs, distinct from tens of thousands of other smaller NBFCs. I believe with the greater scrutiny that RBI enforces, there will also in times be greater support that will be available to these NBFCs to go and build themselves parallel to what banks are doing. In every line of business that we are in, we compete with the best banks. So you don't need to be a bank now with this kind of support that the enabling regulation provides. There are a few asks. For example, if you're a good quality NBFC, why shouldn't you be given a credit card license with the right security in place? Why should you not have an option into a liquidity line of RBI, again with maybe SLR securities securing that, so that you create confidence in the market? Because at the end of the day, we borrow as well. We have a large liability book and we lend against that. So just some of these things which hopefully will come in the coming years, because I'm very clear that for India to build an Atmanirbhar industry, we first need to build an Atmanirbhar, which is a self-reliant financial services sector. And that can't only happen with banks. Either we need 25 more banks, or you need large NBFCs to play this role.
Right. The thing is, you look like a bank, you act like a bank, you smell like a bank, it is a bank, and it has to be regulated like a bank. That's what most people say. So why not have a full banking license? It would only make sense. Because then you are regulated like a bank.
So that's really something for the regulator to decide. We look at the license that's available to us, and we ensure that we comply with that license. But yes, when we do our business, we compete with the banks, we provide service like the banks, and as you said, we look and smell like the banks.
Any expansion plans? I know that at some point you were interested in expanding, but the RBI put a lid to it. I mean, are plans now being revived? Yeah, no, what RBI has been doing is it's been monitoring risk and growth across the sector. And that's where a year and a half back, a couple of our products were paused for a few months, but they are on right now. So wherever they see greater risk, they engage, they do that. And again, as we say, engage early enough so that we can take appropriate action so that our customers don't suffer. And I think they understand that. Beyond that, under Bajaj Finserv, not only are we in retail and small business credit, we are also now in mid-sized corporate lending. We have a mortgage business. We have a digital securities business. We have amongst the largest life and non-life insurance companies. We've started our asset management business. So we are very clear that for every average Indian, we will have the products and services across their financial life cycle from Bajaj. And our aim is to provide them in a transparent manner, in an innovative manner, in a cost-effective manner. And we have a huge market ahead of us. But would you be interested in other markets, like Indonesia, for instance? Well, this outside of this country. This is always a debate, and I would say it's probably a question of when rather than if. There is so much opportunity in India right now that when you draw out an Excel sheet for the next 10 years, the rest still seems insignificant. But at some level, it's less about the monetary impact, but more about people and their dreams. So yes, at some point. Could you shed light on the murmurs out there about Allianz pulling out of the partnership with you? Some say it might happen in March. Could you just give an indication of what is happening there? So there are no murmurs. We reported to the stock exchange a few months ago that Allianz was actively considering an exit from us, but at the same time they're committed to coming back to India in a position of control, because you can have only one captain of the ship, and we are the captain of the ship. We've run the ship well. They recognize that as well. But I can understand that if you're a large company like Allianz, probably the largest insurance company in the world, it's a difficult decision. On one hand, you have two great 24-year-old partnerships, which are going very well, but on the other hand, maybe there's a need for control. So there are discussions that are on. If they head in a particular direction, we will naturally at the right time announce it. Would March be a month to be looking at? Who knows? Sanjiv, thank you so much. It's been a pleasure speaking with you. Sanjiv Bajaj, Chairman and Managing Director at Bajaj Finserv. Now, the Tata Motors Group CFO says India's consumer-friendly budget, which includes a record $11.5 billion in tax cuts, should fuel spending and revitalize growth as long as inflation remains in check. I spoke exclusively with PB Balaji for his outlook on India's economy and the auto industry.
This budget has been a very tricky budget because budget is set in a context. The external context we talked about a little while earlier. In that context, we were so keen to see in the budget that we have an additional lever of growth that is there. Because this country always had strong investment-led growth in the last few years in the way the budget has positioned itself. And even in our analyst call, we explicitly said we hope we see a consumption lever also kicking in, because it's good to have that additional degree of freedom in this kind of an environment. Export-led growth may not be the most, you can't bank on that. If it comes, great, but you can't bank on that in this environment. So therefore, to release almost 1 lakh crore of money into the system through tax reductions, while ensuring fiscal deficit comes down further from 4.8 to 4.4, means there's money going in, but that money won't be eaten away by inflation. And therefore, it's actually money in my hand. And that is 1 lakh crore. That's huge money going into the system. That system means that you're going to have multiple effects starting to play out. And with inflation is not going up, consumption will go up. The minute consumption starts going up, my trucks start flying more and more, because we are the largest cargo movers in the country today. So that starts moving out. While it may immediately go and hit maybe more the two-wheeler segment in terms of the put-on price being lower, but it also starts giving people the aspiration, they have the affordability to go for it. The fact that there are I can now take a tax benefit on 2 houses that is there, means more money is in people's pockets. That gives you confidence, more money, more confidence. immediately means consumption starts going up across the board. So I think it's an excellent move from that perspective, seen in the context of a continued fiscal consolidation. Both have to be seen together.
So you are convinced, you are confident that consumption will increase.
Yes.
How soon do you think that will trickle down to demand for your cars?
I think the tax changes happen from the beginning of April itself. People will see money in their pocket as of April 1st. Or depending on when they pay their taxes, definitely by June 30th, 15th, they have to pay your advance tax. So you will get the money in the pocket by then. So, and don't forget, if my statistics are right, majority of the population is in this tax bracket, which has suddenly become tax-free. So there's only about 1 crore of population that's going to pay taxes. The rest of the guys are not paying taxes.
80% of the workforce,
80% of the workforce. That's huge. And these are the people for suddenly credit start improving. So I do expect from Q2 this year, things start, Q2 calendar year this year, that is Q1 for us in the next financial year, we should start seeing demand coming through.
Could you hazard a guess how much demand that may translate to?
2 to 3%.
What are the challenges that you think the company will face this year? I mean, the uncertain environment externally, the macro environment is not looking good, and growth, of course, is slowing from, in excess of 8% to 6.5%.
So I think this budget will give that, getting it back to the 7-8%. If it gets it, I think it would have done a phenomenal job in terms of numbers. And if I look at my opportunity areas before I talk about concern areas, I think we have not had a great year this year. The previous year has not been a great year in terms of demand. But again, we should split it. Commercial vehicles, I think, is more going through its cyclical shifts that are there. But one should expect to see that coming back in the coming year as demand picks up, because investments are still continuing. There's no change as far as investment plans are concerned. And inflation is benign. I would expect to see interest rates to come down. And
as soon as this month?
I do expect an interest rate cut now, because
25%? 25 basis points?
Because you should see that. I would expect to see that. Should is a forceful statement. I would expect to see that, because two things. One is, if global demand is not so great, inflation is not in the horizon, and the country has lived within its budget and actually consolidated further. So why would I not take that additional punt in terms of go after growth? It will give you salvation for a lot of other problems that are there. And also the concern, even from the market's perspective, if the FII monies has to come back, there will come a time when they reassess, because their portfolio is now moving towards US. It comes back. If you are a fiscally prudent, growing economy, chances of you attracting investments are much, much higher. So that should come through as well. So, and therefore, from a commercial vehicle perspective, costs are benign, interest rates softening, growth in terms of cargo starting to move, and construct segment, tippers, etc. starting to go, you should expect to see construct coming back again. So that piece of it is how I see it. Passenger vehicles had 2 record years, and therefore maybe it's taking a little bit more time than one would have expected. But all you had to go is visit the Auto Expo and see the amount of launches that are happening at this point in time. I think the industry will shake itself out of the challenges it finds itself by just innovating and putting the product intensity and offensive going. So it will probably put more energy to get there, and therefore that should also get back into growth. Will it be scorching growth rates? I don't expect as far as PV is concerned, but it's not needed. I'd rather have a steady, consistent growth rate, and with the innovations backing in, it'll also get everybody in the right place.
My exclusive interview with Tata Motors Group CFO, PB Balaji. Now, India's been trading for about 18 minutes now. It is in positive territory, but quite muted. Sensex index up by 0.5% right now. Remember that it dropped yesterday in line with the rest of the region, which was smacked by prospects of tariffs. Those tariffs now being reversed, at least delayed for about a month. Sensex index currently up 0.6%. We're keeping a very close eye on the Indian rupee. 87.03 is the level we're looking at. Of course, the Indian rupee currently up by about 0.2%, still hovering close to record lows. Well, still to come. I sat down with Nita Ambani, India's first female IOC member, to discuss India's ambitions to host the 2036 Olympics. That conversation is coming up next. Keep it here with us. This is Bloomberg. Welcome Welcome back, and we have breaking news out of Japan. KKR to raise its offer for Fujisoft to 9,850 yen per share, and that's according to the Nikkei newspaper. Again, KKR to raise the Fujisoft offer to 9,850. Fujisoft currently trading higher by 0.7%. Well, it's just a week since Prime Minister Narendra Modi repeated his call for India to host the Olympics in 2036. He's got some influential figures working on that goal, including Nita Ambani, India's first female IOC member. She told me more about the ambitious bid.
I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. India is a land of yoga, and we have had many ancient sports. Archery and weightlifting are part of our old Indian native sport.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? And India has shown how infrastructure has changed in this country and changed cities in a blink of an eye. I mean, what Mumbai was a few years ago, it's completely different now. So I think the move has to be a sustainable move for a bid for Olympics.
Reliance Foundation founder and chair Nita Ambani speaking to us about India's hopes of hosting the 2036 Olympics. And that's just a taste of a wide-ranging conversation. You can catch it in full on the latest episode of Latitude, which premieres on February 13th on Bloomberg Television, of course, on our YouTube channel. Subscribers can also watch on the Bloomberg terminal. A special episode you do not want to miss. Well, in the markets, a reversal from yesterday's sell-off. Asia in positive territory. MSCI Asia Pac Index up by about 1%. What a rally for the Hang Seng, up by about 2%. Remember, the sell-off on the Hang Seng yesterday went up to as much as 3%, and that's on the back of Trump tariffs. And today we heard that those tariffs on Mexico, Canada may be delayed by about a month, and he will be speaking to Chinese President Xi Jinping. Negotiations ongoing, perhaps some reprieve for the Chinese market, which returns after that holiday, which ends tomorrow.